I'd like to thank everybody for joining me today. Today, I want to talk about an important part of the planning process, and that's helping our clients find money that is being spent on taxes. As we go through the planning process, we'd love to be able to plan in a vacuum where our clients have an unlimited amount of resources to be able to do every single thing that we can come up with. But that's not the case. Our clients, have limited resources. So as we do our planning, we want to make sure that we're effective in providing them great solutions. But at the same time, if we can help them, find money that's being lost to taxes, it's a win-win for everybody. As you start looking at the whole process, first let's talk about taxes. Taxes erode income and wealth, and understanding how those taxes fit into the planning picture, really will help you identify where the savings can happen. So these taxes could be payroll taxes, they could be part of the income taxes, both state and federal. And of course, there's capital gains taxes. Now, we also know there's estate taxes, and that'll be for another conversation. But if you start looking at these things that affect our clients' income, the things that they have to deal with on a regular basis, now we can start helping them find that extra money. Part of the planning process is gathering client information, taking the time to really dig in to find out, what's going on in their life today, both from a personal and business standpoint, what their goals and objectives are. And part of this data gathering is getting the tax returns, and not just getting the tax returns, but taking the time to go through them and identify, opportunities for our clients to save money. Now, part of this, if you understand taxes, it's easy to start seeing how to find the planning opportunities, the savings areas. One is the form number. So if we're talking a business tax return, if I see a 1065, that means it's a partnership return. Now, this can be a partnership, a general partnership, limited partnership, LLC taxed as a partnership. Now, if it's an 1120, it's a C Corp, 1120S is an S Corp. This will tell you, are they subject to self-employment tax? And the big trend, and I've seen this trend for a number of years, people will go in and set up an LLC. And this LLC, the LLCs are a great tool, great type of entity structure. But you have to understand, with an LLC, that could be taxed as a sole proprietor. If it's a single individual taxed as a sole proprietor, that's on a Schedule C, subject to self-employment tax. If it's an LLC taxed as a partnership, even between spouses, now that's going to be taxed subject to self-employment tax. If we want to get out of self-employment tax, then we have to go to a S or C corporation, which would be a Form 1120 or an 1120S. There again, understanding the form will help us understand, can we help our clients save some money there? Now, if you start going through and just looking at the front part of this tax return, do they have any depreciation? Well, if they have depreciation on their tax return, now we can look at this. Can we do a cost segregation? Cost segregation, if it's done properly and if it's warranted, we can accelerate a lot of their depreciation on their buildings, and take those buildings that are going to be basically 30 depreciated over 39 years. Well, we can accelerate maybe 20, 30, 40% of that and take that as an immediate write-off. So looking to see, is there an opportunity in the depreciation area, is a good thing to look at. Now, you've got to understand that depreciation can show up either on the business return, it can show up on the personal tax return. This will be under Schedule E is where you would look for that. So it's going to be showing up as a rental. So there again, as rental property Schedule E, there can be depreciation there. Now, we want to be careful here, because we want to look and see, can our client actually take more depreciation? If this is one, if they're the casual investor, think about a doctor that has one or two rental properties. Well, as one or two rental properties, they're not treated as a real estate professional. So their passive activity, their rental activity, is treated as passive activity for the tax code. And they can only take losses up to the amount of income for that year. Any excess losses are going to be carried forward to be used in future years, or when they sell that asset, they can go back and collect all of that unused depreciation, unused losses. So as you start looking at this, make sure we're not getting a client excited about cost segregation to all of a sudden say, whoops, you can't use it. It would have been a great thing if you could, but you can't. So we've got to be careful there. So take a look. There again, depreciation on the business return. Depreciation can be on the personal return as well. And if they have the depreciation, they have rental real estate, let's look at a cost segregation to see, can we help them basically take advantage of that depreciation deduction now and offset those taxes currently instead of over the next 20, 30 plus years. As you start moving through the business return, look at it and see, do they have taxable income? Is this company profitable? If it's profitable and, early in the early phases of the business, they may not be as profitable, so they may not need as many deductions. But as they become profitable, now they're looking at ways to save taxes. So if they've got taxable income, then potentially a captive insurance company. If they're a business that has significant risk that they can turn into deductions, a captive insurance company can be a great way for them to offset large deductions against their current income, so that they can take maybe up to 1-2 million plus in deductions against their current income. So captive insurance companies can be a fit if it's a company that has income and has significant risk that they want to offset. The next thing to look at on the business return, do they have employees? Now, this is a big area that we're seeing right now is employee retention. And employees, you used to, you used to have to look and say, am I going to lose my key employees to my local competitors? Well, now it's not local competitors, it's sometimes national and international competitors as well. I'm seeing clients that are, employees on the East Coast being poached by companies on the West Coast, letting them work from home and, giving them a little bit more of a better work environment, maybe not more pay, but more of a casual work environment. So you start looking at, this could be an area to talk about employee retention, golden handcuffs, R&D credits. So these are areas that we just need to start looking at. Can we do more with with our client to help them retain this key employee capital that they have, this key asset to the business, and make sure this is something that they can use going forward. Next thing to look at is, moving over to the personal tax return. Do they have significant income? Now, it's harder in some cases to plan for an individual versus a business. And we just don't have as many areas to play in. But if they've got, significant income and they're a W-2 employee, are they maxing out their deductions? I mean, their retirement account. Are they taking advantage of everything there? If they have, the only other place to really plan on the personal tax return is in charitable deductions in the itemized deduction area of the tax return. So when we're in the personal space, we really have to be, looking at, do they have the ability to set up a business? If they're a W-2 employee, but they have the ability to set up a business, now we have other opportunities that we can plan for. So there again, looking at the tax return can help you do this. So what I look at is, as you go through the planning process, take the time to get the client's data. One of those pieces of data is going to be the tax returns. But now start using that tax return to, one, understand what the client's, doing, how they're utilizing their tax planning, and are there opportunities to help them save money in their taxes so that money can be repurposed into other planning opportunities. So take the time, to help your client and as you help your client, it's going to help you grow your business as well. So I appreciate everybody getting on, and we'll talk again next week. Thank you.